The Federal Reserve Bank just raised interest rates for the first time in 2023. The Fed just raised interest rates by 0.25% as a way to cool down inflation and as a way to cool down the economy. And interestingly, right before Jerome Powell and the Fed announced this new interest rate hike, we saw layoffs. FedEx announced that they're going to be laying off about 10% of their company, and then Rivian announced that they're going to be laying off about 6% of their economy due to slowing sales. Now, the big question here is, what does this mean going forward for the Federal Reserve Bank and interest rates and inflation and the economy? Because the Federal Reserve Bank last meeting in December, they announced a 0.5% interest rate increase. In the meetings prior to the December meeting, those four prior to December, the Federal Reserve Bank raised interest rates by 0.75% each time. So we're seeing that the Federal Reserve Bank isn't being as aggressive, but they're still working to raise interest rates. And this is where now everybody is debating if the Federal Reserve Bank's fight on inflation is over, or if they're going to stay committed to continuing to bring inflation down. Like on CNBC, as soon as the Fed made their announcement, there was a group of panelists and analysts who were debating over what's going to happen next. And you had some people saying, this is it. We're not going to see an interest rate hike in March. The Federal Reserve Bank is just going to hold here, and maybe they're going to start cutting later in 2023. And then you had some other people saying, no, the Federal Reserve Bank is going to stay committed to raising interest rates. Now, of course, we don't know what the Fed is going to do until they actually do it. But Jerome Powell did say that, quote, the Fed is going to stay committed on their inflationary fight. They said that they're going to expect more ongoing rate increases, but they might not be as aggressive as they were saying, assuming that inflation stays on this trajectory down. Now, earlier today, I released a video about Michael Burry and his opinions, where he says that the Federal Reserve Bank is going to slow down due to a slowing economy, and then eventually they're going to pivot and start inflating because we're going to go into a deeper recession, which is then going to cause an even bigger inflation problem. But this is where you have people like Jerome Powell and the Federal Reserve Bank saying, no, we don't foresee that type of severe economic pain, and that these small interest rate hikes are going to be sufficient enough to bring inflation down because of something called the lag time. This lag time that Jerome Powell is referring to is essentially the 7 interest rate hikes that the Federal Reserve Bank in 2022 is going to take time for these interest rate hikes to get absorbed into the economy. Essentially, it's going to take time for people to absorb the higher prices of things. The reason why the Federal Reserve Bank is working to raise interest rates is because it reduces demand. When you increase interest rates, it makes buying a home less affordable. It makes buying a car less affordable. It makes going into credit card debt less affordable. It makes financing a business operation less affordable. And so if these things are less affordable, well, naturally, less people are going to buy them. If less people are buying them, that cools down demand, which cools down how fast the price of these things are going up. Because if you think about the housing market, the price of homes are determined by supply and demand. When you have more buyers than sellers, the price of this asset, the home, goes up. When you have more sellers than buyers, the price of this asset is going down. So the Federal Reserve Bank wants to make things less affordable because that means you're going to have less buyers, which then will cool down the inflationary pressures, meaning make it less likely for the price of these things to go up. Now, tomorrow on Market Briefs, we're going to have a full analysis over the interest rate hikes, what the Federal Reserve Bank is doing, and the economy. If you haven't joined Market Briefs yet, it's my free newsletter where every day my team is breaking down what's happening in the economy, the stock market, the real estate market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. Now, the question here is, what's going to be coming going forward? Now, the reality is we are seeing a slowdown in the economy. The reality is we are still facing high inflation. And the reality is these higher interest rates are going to play an effect on the economy. This higher interest rate is going to put more upward pressure on mortgage rates and credit card rates and car rates, which will slow down some of these markets. But the key here is really paying attention to the economy, because over the last 2 months, from November, December to January into February now, what we've been seeing is we've been seeing a lot of layoffs, obviously in the tech sector, but we've been seeing more and more of these layoffs spill into other parts of the economy. Like we saw 3M announce layoffs. Bed Bath & Beyond said that they could be declaring bankruptcy as early as this week. So we're seeing a lot more different pains in the economy, where originally everybody kept saying that these layoffs and the slowdown is going to be contained just to the tech sector. And if these higher interest rates persist and we continue to see more pain in the economy, that's going to have a trickle-down effect. Now, every time you raise interest rates, that causes a further slowdown in the economy because, well, you make things less affordable. Our economy runs on spending. The more money you spend at Chipotle, the more money Chipotle makes. Well, if you've been able to buy Chipotle because you could put it on your credit card and you could get the double meat and the extra guac, Chipotle was making more money. But now if you're racking up your credit card debt and you can't keep affording the extra guac or the double meat, or maybe you can't even afford the Chipotle, that means Chipotle is making less money. And some of the videos that I made on the Minority Mindset channel, because I know I'm trying to do more of these daily updates on this Clips channel, but one of the videos that I talked about was the issues that corporations are facing. And the issue that corporations are starting to see and will continue to face over the next year to 3 years is their corporate debt levels. We are seeing some of the highest corporate debt levels ever. And not just that, the interest rates on these corporate debts are rising because these corporate debts aren't fixed rate debts. These corporate debts are many times variable interest rate debts, meaning they readjust after every 1 year, 2 years, 3 years, 4 years, or 5 years. So every 12 months, you're going to see more and more of this corporate debt readjust at a higher interest rate. When it does, now the corporations are going to pay higher prices to cover their debts. Now, that's not a big deal, assuming you're making enough money to cover these higher costs. But many corporations are starting to see their revenues start to stall or start to slow down because we're seeing the economy slow down. Why is the economy slowing? Because people are spending less. Why are people spending less? Because inflation is still high, things are becoming less affordable, and people's incomes are not keeping up with inflation. Then, at the same time, you have to look at what corporations have been doing with their money. Why are their debts rising? Is it because they've been investing in productive assets, meaning are they putting their money into things that are making them more money? Well, over the last couple of years, we saw a record amount of levered corporate buybacks. That means corporations have been using their record cash piles, going into debt, and then using all this money, their cash and this debt, to go out and do stock buybacks and to go out and do dividends. Meaning they've been using this money and debt to go and make the shareholders richer. Now, this is great in the short term because now the stock prices go up, investors are making a lot of money. But when you start to enter an economic downturn, that can really pose problems because now you have all these liabilities on your books as a corporation. And these liabilities aren't funding an income-producing asset. Like, it's as if you go out to the Gucci store and you buy a whole bunch of handbags and you finance them, and then next year you lose your job. You're financing a liability. And that's what many corporations have been doing the last couple of years. They've been financing these liabilities, which is the stock buybacks and the dividends, which is great in the short term because now everybody's getting rich. But then if you start to see incomes go down because revenues are going down, you're left with the payments. And these payments are rising. They're rising not because they're going deeper into debt necessarily, but they're rising because the interest rates on these debts are rising. Remember, corporations don't have a 30-year fixed rate mortgage. They're variable interest rate mortgages. So the costs on this corporate debt is rising. Then we also have our national debt costs, which are rising. Just like corporations, our government doesn't have a 30-year fixed rate mortgage. A lot of our national debt, which is almost $32 trillion now, but a lot of our national debt has a 5-year term or less. That means it's going to be readjusting in the next 6 months, 12 months, 18 months, and 36 months. Over the next number of years, we're going to see more and more of our national debt readjust. And that means that our costs as a government are also rising. And that poses a real problem now because when the government costs rise, how are they going to service those costs? Well, the government can only make the money from one place, taxpayers. That's the only way that they make money. Everywhere else, they have to borrow money. When they borrow money from other countries, they have to pay it back. When they borrow money from the Federal Reserve Bank, they have to pay it back plus interest. But the only place where they can get this money is from taxpayers. And so unless the government starts cutting their spending, which is something we haven't really seen happen anytime in recent history, unless they start cutting their spending, you're going to see more and more pressure on the government to increase taxes or find a way to continue making these payments because the cost of these payments are going to go up. And there were some proposals, some crazy proposals of people saying, well, can't the government just work to print money to pay off their own debt? Which really is one of the most absurd things you can ever really think of because the government created this debt out of thin air. They worked with the Federal Reserve Bank to create this debt and they want to pay it off with the same fake money. that could cause a lot of problems. Now, that hasn't really progressed too much, but this is where you have to start paying attention over the next couple of years. As the cost of this government debt continues to rise, how are they going to pay it? Are they going to raise their taxes, or what else are they going to do? And in addition to that, we also have the household consumer debt levels at the highest levels ever. And as things become less affordable due to the higher interest rates, that's going to play an effect on the economy. So what does this all mean? Our economic craziness of 2023 isn't over. 2023 is going to be a crazy economic year. Now, obviously, I have my own opinions. I'm going to be honest with that. I believe that we're going to see more economic pain in 2023. You can have your own opinion. You can disagree with me. That's fine. That's my opinion. But what I'm trying to say is no matter what your opinion is, be prepared for anything. It costs you nothing to be prepared, but it'll cost you everything if you're not prepared, and we continue to see more pain in the economy. That means live a little bit smaller right now and put some cash aside to protect you and also capitalize on opportunities that might come your way.